Coming up on Retiring Well with Michael Reese.
Folks, retirement is a fundamental change in your life. It's not surprising that your goals change at that point, which means your strategies and tools should change. And guess what? If they don't take their required distribution, 50% penalty, 50, big number. Don't let them mess that up. But they each get to stretch it over their lifetime under current rules. That's a cool thing.
Now, the host of Retiring Well, Michael Reese.
Welcome to the show today. We have 30 minutes of action-packed information specifically designed for you. Retiring Well starts right here, right now.
Retiring Well with Michael Reese, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well with Michael Reese, where we believe your best is yet to come.
This week in CFP Talk, I want to share with you what is probably the biggest mistake that people make with their retirement planning. And I have a little story about my grandparents to share that really highlights the mistake that is made. See, my grandfather and grandmother, they were both school teachers, and they had a dream. They wanted to retire and buy a cottage up in northern Michigan on a lake. And so my grandfather, he's a big believer in dividend-paying blue chip stocks. That was his deal. He loved dividend-paying blue chip stocks. So what he would do is he would save up money, and he would, as he accumulated savings, he would buy, a portfolio of these dividend-paying stocks. Now, what happened was, over time, he accumulated a decent amount, and when he retired in 1971, he had about $300,000 in that portfolio, which is worth like $1 million plus today, right? This is back in 1971. And so what they did, my grandparents, they were able to realize their dream. They bought the cottage on the lake. The only problem is my grandfather kept investing in those same, he never changed his investments. He kept them the same dividend-paying blue chip stocks. And what happened in the early 70s, right after he retired, markets started going down, so the value of those stocks went down, the dividends that they paid went down, and then inflation started going up, so he had to pull more and more money out of an account that was going down and down in value, and you can only guess where that went. He ended up running out of money. Now, what happened? What happened to my grandfather is the same thing that happens in the financial industry. Financial advisors, they fall in love with what I call the shiny object. For my grandfather, the shiny object was blue chip stocks. For the financial advisors, usually it's some tool, some place where you can put money, and they fall in love with it. So it might be, a real estate trust that they fall in love with. It might be a mutual fund portfolio. It might be an annuity. Whatever it is, they fall in love with some tool. And so what they do in the financial world is they say, all right, let's start with a tool. Now that tool could be stocks, bonds, mutual funds, exchange-traded funds, annuities, real estate, limited partnership, options, commodities, futures, IRAs, 401ks, 403bs. There's tons of tools. And what do? They say, I'm going to fall in love with one of these tools. Let's imagine they fall in love with some mutual fund, a company that sells mutual funds. They've got some asset allocation that's kind of neat that this advisor thinks. And so I say, wow, I really like that. So how do I sell that tool to, people just like you? Well, they say, what we have to do, we've got to figure out some strategy to sell the tool. If it's a mutual fund portfolio, they might say, let's create an asset allocation strategy. So when people come in, we'll ask them a questionnaire, and we'll create a pie chart, a pretty looking pie chart that shows asset allocation, and we'll use that as our strategy to sell these different mutual funds. There are a lot of strategies you could have. You could have a growth strategy, an income strategy. You might have a preservation strategy, asset allocation we talked about, maybe a tax strategy, a long-term care strategy, a lot of strategies we could have. But the idea is start over here, figure out a strategy, and then once we get the strategy, we need to identify how is that going to fit one of your goals? For my grandparents, it was buying a cottage. But what about you? Maybe your goal is you want to travel. You want to focus on family after you retire. You want security, freedom. A lot of goals that you have for your retirement. So we start over here, we go this way. What mistake did my grandfather make? His shiny object was what? Dividend-paying stocks. That is a growth strategy, which worked terrifically when he's trying to build up assets so he could retire and get his goal. But the minute he got the goal and he retired, everything changed. He didn't need growth anymore as much as he needed inflation-protected income. He needed a different strategy, which means different tools, but he never changed because he had that shiny object syndrome. What should you be doing? You should start over here with the goal. And then once you know what you want, you develop a strategy, a set of strategies to support that goal. And then from there, you don't start with the tools, you finish with the tools. Folks, retirement is a fundamental change in your life. It's not surprising that your goals change at that point, which means your strategies and tools should change. Now, if you have any questions about this or anything else we talk about in the show, please give us a call.
Since 2000, we have seen the market drop to half its value a couple of times. We are now in the second largest bull run of all time. Is the bear poised to strike again? Many are speculating that it is, but we are not going to take that position. The truth is, no one can predict when because they always come unexpected. The key is being positioned to handle it no matter what happens.
By objective, a mutual fund will hold the securities it said that they would hold in the prospectus. For example, a large cap mutual fund is going to hold large company stocks. If the market crashes like it did in 2008, then what does that large cap mutual fund do? Think about it. Will they go to cash?
You will be hard-pressed to find a large cap mutual fund that did not go right down with the market. Don't be caught being passively invested like that. What you want is active management. You want someone managing the downside as well as the upside. Also, don't get caught in the buy and hold trap. You have to remember that in 2008, when the market crashed, it started in December of 2007 and ended in March of 2009. Think about it. That was a 15-month period. Every month, people were getting their statements and they would ask their advisor what they should do.
And what was the mantra? Just hold. It always comes back. Sure it did, almost 4 years after it hit its bottom. We think that is unacceptable. It is also critical to understand what you are paying in fees. It continues to amaze us how little people understand what they are paying.
There are only two ways to grow a portfolio. One is by the interest and dividends being earned by the underlying securities, or what we call yield. And two, by appreciation, the idea that a security will grow in value. If I'm trying to grow to get a 6 or 7% return, and I'm only getting 2% in yield, and I'm paying fees of more than that, then my whole portfolio is relying on speculation. That's where you get volatility. We have all been taught you can't have great reward without taking great risk. It is not true. You can achieve market-like returns without volatility.
We have the tools today to show you how much risk you are taking. We have the tools today to show you how much you are paying in fees. Don't you think you have the right to know? To the first 10 callers, we will perform a risk and fee analysis for you absolutely free. If you had a life-threatening illness and the doctor was prescribing a critical procedure, well, wouldn't you find it appropriate to get a second opinion? You have saved retirement your whole life. Don't you think your life savings deserves a second opinion as well? Again, for the first 10 callers, we will do the risk and fee analysis and we'll show you how to avoid being just passively invested. Give us a call.
Welcome to another edition of True or False with Mike Reese. I'm Craig Sear, and Mike, are you ready for us this week?
I am ready and able and all that other good stuff.
All right, first question. Not all financial advisors are true fiduciaries.
So true or false, not all financial advisors are true fiduciaries. Is that correct?
Right.
Okay, that one's true, right? Not all advisors. In fact, we could almost argue that almost no financial advisors are true fiduciaries these days. So what is a fiduciary, right? I'm sure at home, as you're watching this, I'm sure you've heard the word fiduciary, right? You've heard the word, but what does it really mean? What is a fiduciary? What does that really mean? And what it really means, of course, is, especially in our world, a fiduciary is somebody who truly focuses on what's best for that person. So if we're talking to John and Mary, our goal as true fiduciaries is to focus on John and Mary and help them make smart choices with their money and give recommendations that are truly best for John and Mary, and with no conflict of interest on our side of the table. Now, the problem, of course, is in the financial world, you would hope that all financial advisors are like that. I mean, wouldn't you hope for that? Wouldn't you hope that when you talk to a financial advisor that they're truly focused on what's best for you? That's what we would hope. The problem is, however, very few truly are. Almost all financial advisors, they give you advice it's okay for you, but it's not really what's best for you. See, there are two standards of care in the financial industry. You have the fiduciary standard, which is that's the high standard, but then you have suitability, and that's it's okay. And conflicts of interest are fine, like revenue sharing, where companies where somebody puts you in a mutual fund because is it best for you? No, it's because that mutual fund company is paying a kickback to the firm. So this is an area that people, you think your advisor's looking out for you. A lot of times they're not. And listen, folks, this is why we tell you, call the office, come on in and visit with us, get a second opinion, see what it's like to actually visit with a true fiduciary. Odds are good you've never spoken to one before, and it's a real different experience.
Yeah, a lot of people think that just to be a financial advisor, you'd have to have someone's best interests at heart, but it's not always the case.
Yeah, unfortunately.
All right, next question. You should wait until age 70 to begin taking your Social Security benefits.
Wait until age 70 to take Social Security. Oh, gosh darn it. Do you guys see what he's doing here? This is true or false, and you're throwing me a question that I have to say it depends on. I can't say that's true or false. This guy. So sometimes, yeah, you should wait till age 70. But sometimes you shouldn't. And
when should you wait until 70?
Yeah, so that's maybe that's a good question. So here's the thing. As you know, there are all these, the big rage in the financial industry these days are these Social Security income calculators, where what they do, I don't know if you've ever had one of these done for you, but if you have an analysis done by a Social Security calculator, I mean, pretty much the answer is always the same. Wait till age 70, right? I mean, that's typically what they say. But here's the problem. What if you retire and you're 65? You retired 65. Should you wait to age 70? Well, if you do, you have to spend, all your income comes out of your portfolio between then. That's 5 years where your portfolio has to generate, a big chunk of your income. That might drive your portfolio values down over time. You might have less money to pay for things like long-term care later on, or less money for your surviving spouse. The reality is, it really depends. If you retire before 70, it might make sense to take a little less Social Security up front to protect your portfolio values. If you live a long time, waiting till 70 it is a benefit, but you have to factor everything together. It's not just one simple answer. And you know what, Craig, he knows that, and he's just trying to trip me up. So that's what's really happening here. See, look, you can tell. Look at him. He knows he's trying to trip me up here.
Caught me. Guilty as charged. Well, thanks again, Mike. And if you've got any questions at home about any of these topics or any topic at all, just give us a call and we'll help you get it figured out.
Will your retirement vision be your retirement reality? Centennial Wealth Advisory invites you to an eye-opening and exciting event packed with up-to-date, valuable, and important information. Join us for a free presentation with complimentary gourmet dinner and find out what you're missing on these vital topics. What is the suitability versus fiduciary standard of care in the financial services industry? What are the biggest tax traps? What are the hidden costs in mutual funds? Why is getting a second opinion the most important financial decision of your life? And much more. Choose the date and location that works best for you. Tuesday, June 20th at the Otsego Club in Gaylord, or Tuesday, June 27th at the Inn at Bay Harbor in Petoskey. Presentations start at 6 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 or visit sen-wealth.com to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, making your retirement vision a reality. Call 888-608-5825 today.
This week in IRA Focus, we're going to talk about beneficiaries and how do they work with IRAs. Now, when I use the term IRA, I really mean IRA or 401k or 403b or 457 or any of those tax qualified retirement plans, because they all have the same rules when it comes to beneficiaries for the most part. There are some small differences between plan type, but for the most part, they're pretty much the same. But you need to understand how the rules work so that you don't get yourself into trouble by accident. So let's go ahead and let's look at 3 different rules that you need to know about. All right, rule number 1. Rule number 1 is this: IRA beneficiaries supersede it supersedes your will, your trust, everything else. In other words, it does not matter what your will says. It does not matter what your trust says. All that matters with an IRA or a 401k or a 403b, any of those types of plans, all that matters is you die, the money goes to the named beneficiary on those plans. So I'll give you an example. Let's assume, for the sake of discussion, that way back when, and there are cases of this, way back when you started some IRA a long time ago, you weren't even married yet, right? You weren't even married yet, and you named your parents maybe as the beneficiary of that IRA. Well then, what happens? Some years go by, you meet a young person, you get married, and the next thing you know, you get a will, you get a trust, you say, okay, in my will, in my trust, all of my assets go to my surviving spouse, right? Let's say that's what you do. But you never go back on that old IRA and you never change the beneficiary on that old IRA. Your wills and trusts say your spouse gets the money, but that old IRA still has a beneficiary. It says mom and dad. You get hit by a car and you die. Who gets the money? Mom and dad. Whoever's listed as beneficiary in that IRA, that's who gets the money. Does not matter what your wills and trusts say. So the only way that your wills and your trusts determine where your IRA money goes or where your 401k money goes, etc., is if you name that your trust as the beneficiary, or if you name your estate as the beneficiary, which most of the time you don't want to do either of those things. Okay, so that was rule number 1. What's rule number 2? Rule number 2, spouses have special options. That's right, spouses get special options. They get to do things that nobody else gets to do. Example, you have an IRA. You die, you leave it to your surviving spouse. That surviving spouse gets to do something that nobody else gets to do. That spouse gets to erase your name off the IRA and write their name in. So it becomes their IRA. Nobody else gets to do that. Only your spouse can do that. So that's kind of a cool thing. A lot of options for spouses. You want to make sure they're taking advantage of those. Now let's look at rule number 3, things you need to know about IRAs and beneficiaries. Here you go. You've done the right job. Your beneficiaries are up to date and everything's done properly. and then you die. And it goes to your spouse, but maybe your spouse is already gone, or maybe you guys die at the same time. So now you're saying, no, I want it to go to my 3 kids, my 3 children, equally. Well, here's the thing. Make sure you list those 3 children separately on that beneficiary. Just don't check a box that says all children equally. List those 3 children, because then what happens is each of those 3 children, they get to have, now the IRA stays in your name, so it's listed John Smith, it's your IRA, but now it's a beneficiary IRA, they call it, for the benefit of that child, and each child, they have a required minimum distribution schedule of their own. And guess what? If they don't take their required distribution, 50% penalty, 50, big number. Don't let them mess that up. But they each get to stretch it over their lifetime under current rules. That's a cool thing. That is a really cool thing. Deferring those taxes over a long period of time can really be powerful, but it's all got to be set up properly. All right, there's your 3 rules with IRAs, right? 3 rules. Beneficiaries. Beneficiary arrangements supersede everything else. Spouses have special rules, and make sure you take care of your kids, set them up properly. If you have questions about this or anything else we talk about on the show, please give us a call.
Will your retirement vision be your retirement reality? Centennial Wealth Advisory invites you to an eye-opening and exciting event packed with up-to-date, valuable, and important information. Join us for a free presentation with complimentary gourmet dinner and find out what you're missing on these vital topics. What is the suitability versus fiduciary standard of care in the financial services industry? What are the biggest tax traps? What are the hidden costs in mutual funds? Why is getting a second opinion the most important financial decision of your life? And much more. Choose the date and location that works best for you. Tuesday, June 20th at the Otsego Club in Gaylord, or Tuesday, June 27th at the Inn at Bay Harbor in Petoskey. Presentations start at 6 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 or visit sen-wealth.com to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, making your retirement vision a reality. Call 888-608-5825 today.
Hello, welcome to Coffee Talk. My name is Larry Flynn. I'm here with Art Canfield and John Torbett, my colleagues. In the course of a day and a lot of our meetings, we get questions all the time, and we just want to take an opportunity to maybe answer some of those here on the show. So let's do that, guys.
Okay. John, one of the first ones that comes to my mind that we've heard recently is Mike talks a lot about on a television show about volatility, the goods and bads of volatility. Why should I avoid that, and how do I deal with it?
Right. I mean, ultimately, when you're coming up to retirement and everything, there's a transition. You've been in what we call sort of the growth and accumulation phase of your life, where maybe you've seen the ups and downs, but you thought, hey, I've got time here on my side where I'm going to be working for another 10, 20, 30 years. But then retirement, it's more this shift to more preservation and income mode. So that's where now this volatility piece needs to be reduced ultimately, right? Because you're wanting to preserve that money and generate an income stream. So that's where really like standard deviation comes into play.
Yeah, what do we see people come in? They're always talking about their average, right? Mm-hmm. They look at their mutual funds, they look at here's what it's performed over a period of time, here's the average return, right? What they don't recognize is that if that account's had any volatility associated with it all, especially in the negative, they're not getting the real return they think they are. Mike's done this on the show, right? If I had an account that made 50% one year, 50% or lost 50% the second year, made 50% the third year, and maybe lost 50% the fourth year, when you do the math on that account averaged 0, but it had a real loss of almost 43% in that 4-year period. Right. But if you take that same you take a different account and it gets basically 0% every year, it also averaged 0, but you would have not lost any money.
Right. The investment world that everybody lives in now, it seems like everybody's so focused on average return. And when it all boils down, especially in these volatile times that we live in now, really since 2000, it's just a different ballgame. It's a different playbook that you have to play by, especially when you're pulling income.
Mm-hmm. You know, it's funny, if you would have had an account that just would have made just a little over 4% since year 2000, you would have outperformed everybody in the market, taking all the risk and volatility associated with it, right?
Right.
Yeah.
I mean, that's the thing people don't understand. And then the other thing they don't understand is if you're especially taking income from that portfolio, it's even more imperative, right?
Oh, most definitely. And that leads us to the next question here. And Art, I'll come to you with this. What is a safe amount to take out of my savings for income? I hear all kinds of different numbers.
Boy, for the person that's about to retire or wanting to retire, that's a question we get all the time, because that's their lifestyle, right? That's what they're going to live on, between maybe Social Security if they're lucky enough to have a pension, and then this withdrawal rate that's coming out of their savings. You know, that safe withdrawal, if you read the reports, it can vary from anywhere from like 1% on up to upwards of 5%. But you know, I think with our company here with Centennial Wealth, when we structure it properly, and going back to what you guys have talked about the last question, when you avoid that volatility, you should be able to get that 5% withdrawal rate, and that's based upon your total portfolio. Most people are okay with that. You know, if I'm making 5-6%, pulling 5%, they're fairly happy that I'm being able to conserve my nest egg, keep that savings. The danger lies when you're taking too much risk, right, guys? Mm-hmm. You take too much risk, and then all of a sudden it's not such a pretty picture after a negative year.
Yeah, the key thing that Art said is when structured properly there. I mean, it really is, we talked about it before, your growth and accumulation phase, maybe you're taking on that risk, but when it comes to preservation and income for retirement planning, that's where it's a whole different ballgame, and that's sort of what we specialize here at Centennial Wealth Advisory, is more preserving your assets. You're still getting positive returns over time, but it's reducing that volatility factor, because you can't live with a 30-40% loss. That means you potentially need to go back to work, and so that's something that we need to stay away from.
Yeah, wasn't it late 90s, the safe withdrawal rate for a traditional stock bond portfolio, maybe 50-50, was like anywhere between 4 and 5%. Today, you know, fast forward 16 years, and now that safe withdrawal rate for that atypical portfolio is like 1.7%. Right. I mean, it's ridiculous.
For most people, that's unacceptable.
Yeah, yeah. Anyway, well, thank you again for joining us for Coffee Talk. If you have any questions you want to ask, certainly call our office and shoot them, and we'd be glad to answer them. So, thank you.
Thanks everyone for watching the show today. Now, if you have any questions, feel free to call our office or visit our website. And remember, you only retire once, so let's get it right the first time. We'll see you next week.